Welcome to this weekly installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week. My name is Summit Puri and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting the key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll discuss the Fed FOMC decision. In point number 3, we'll talk about DeepSeek AI. And in point number 4, we'll talk about the impact of tariffs. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed's seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a healthy 2.9% growth as of January 31st, which is down from the 3.0% reported last week. You'll hear this throughout this conversation, that the impact of tariffs on various aspects of our economy. However, if GDP is a measurement of how the economy is performing, current predictions show that if the tariffs stay in play for long term, we may see up to a 1.5% decrease in GDP. Yes, that's a large number, considering that 70% of our GDP is consumption-based, and that by increasing tariffs on both ends, we'll see higher inflation, which means higher costs for the same goods you currently purchase. In many cases, this will lead to decreased spending, thus lowering consumption. We will certainly continue to track this moving forward and update you all on the impact as more information becomes available to all of us. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data fell by 16,000 claims, ending at 207,000, while continuing claims also fell by 1.858 million. We'll continue to watch this metric closely while the new administration continues to make waves. As I mentioned last week, I fear we may see this tick higher in the upcoming months. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw a minimal movement in the 30-year and 15-year mortgage rates, ending at 6.95% and 6.12% respectively. We'll discuss the FOMC's decision to keep rates higher for longer in point number 2. One important relationship to point out here is that mortgage rates are not directly related to short-term federal funds rates. I'll make sure to explain this relationship in more detail in the upcoming weeks. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull to bear spread fell from 14% last week to a positive 6.93% this week. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME FedWatch tool is calculating an 18% probability of a 0.25% decrease and an 82% probability of no decrease in March. Since this is early in the cycle, I wouldn't put too much weight on this data. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 0.48%. The Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, was positive 0.17%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 0.79%. International stocks took the win again this week. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On your screen, I've highlighted key moments from the past week where we see Monday, the markets reacted to the news of DeepSeek. Tuesday and Wednesday, the FOMC expectations and announcement. And on Thursday, the news of tariffs being implemented. We'll dive into each of these in the upcoming slides. Now into point number 2, the FOMC decision. The Federal Reserve decided last week to hold interest rates steady, pausing further cuts after 3 reductions beginning in September of 2024. The benchmark federal funds rate will remain in the range of 4.25% to 4.5%. On your screen, you see the effective funds rate. This is an average of the high and low range. The decision was influenced by concerns that inflation, which has remained near 3%, could be reignited by additional rate cuts. The Fed also noted that the labor market is quote unquote solid and that the economy is in a quote unquote quite a good place, showing growth in GDP and job gains. Fed officials are also waiting to see how President Trump's economic policies might impact the U.S. economy. Specifically, they're watching for potential inflationary effects of policies such as tariffs and stricter immigration. The Fed has removed language from their statement that suggested inflation was moving towards their 2% target, indicating that they are now taking a more cautious approach. This pause in rate cuts will likely have implications for consumers, with borrowing costs on credit cards and loans remaining really high. Although the Fed has projected 2 rate cuts for the rest of this year, it is not likely that any of that will happen anytime soon. And borrowing costs are expected to remain higher than in the years leading up to the pandemic. Savers, however, are benefiting from the current high rate environment, with high yield savings accounts and CDs offering the best yields in over a decade. The highest yielding savings accounts currently offer an APY of 4.75%. Despite the Fed's pause, the housing market remains a challenge, with mortgage rates remaining really high and home prices have reached record highs. On to point number 3, DeepSeek AI. DeepSeek, a Chinese startup, has gained global attention for its AI models, specifically DeepSeek V3 and DeepSeek R1. These models are claimed to rival those of US tech giants like OpenAI and Meta, but at a much, much lower cost. The company has reported that training DeepSeek V3 requires less than $6 million in computing power, while DeepSeek R1 is reportedly 20 to 50 times cheaper to use than OpenAI models, essentially stating that they're cheaper to produce and more efficient. As many of you know, the cost of AI and energy consumption has been at the forefront of many discussions since the pandemic. It's important to highlight that the biggest loser in this announcement was NVIDIA, whose stock fell by 17% just on Monday alone. DeepSeek has apparently produced a product that can use lower-end chips to output high-quality results, not leveraging the high computing capabilities or requirements of the most expensive chips offered by NVIDIA. Also, those are the same chips that have 90% margins for NVIDIA. Only time will tell how this all plays out, but many feel that this may be the turning point for accessible AI and cost reduction. On to point number 4, the impact of tariffs. I believe it's important that we start this conversation to address the question, what are tariffs? Tariffs are taxes imposed on goods imported from other countries. These tariffs are typically a percentage of the product's value, but can also be a fixed amount. Companies that import goods pay these tariffs to the U.S. government, and likely these costs are often passed to consumers through higher prices. What is important here is that the tax is paid by the importing company or the American company bringing in goods or products into the United States. This is a very important distinction. On Saturday, the White House announced the imposition of heavy tariffs on goods exported from Canada, Mexico, and China, with all of the nations announcing their intentions to retaliate. The tariffs, which are set to go into effect midnight on Monday or February 3rd, include a 25% tariff on all goods imported from Mexico, a 25% tariff on all goods imported from Canada, except for energy products, which have a 10% tariff, and a 10% tariff on all goods imported from China. These tariffs were enacted by the president using emergency authority, claiming the need to combat the flow of illicit drugs, although Congress is normally involved in setting tariffs. In response, Canada announced 25% counter tariffs on $155 billion worth of U.S.-made goods, with $30 billion worth of goods starting on Tuesday, and the ramping up to the full amount after 21 days. Mexico and China have also pledged to take countermeasures. These tariffs and retaliatory measures are expected to have significant economic impact. The tariffs could raise prices and slow economic growth, with the U.S. importing $1.36 trillion in goods from just these three countries last year. It is estimated that the president's tariffs would have implied an average import tax of 19% on these goods. If these increased costs are passed on to consumers, the consumer price index could be expected to increase by over 1%. Additionally, the U.S. exported roughly $760 billion in goods to Canada, Mexico, and China last year, and slower economic growth in these countries combined with retaliatory tariffs could significantly reduce those exports. For investors, this trade war poses significant concerns. The current economic environment shows a strong U.S. economy with high equity valuations. The trade war could lead to a stagflationary environment with increased inflation and interest rates, while simultaneously dragging on economic growth and profits. This could make U.S. equities with high valuations vulnerable, while non-U.S. and real assets may provide portfolio balance. The overall recommendations for investors is to ensure a well-diversified portfolio to navigate these uncertain trade conditions. The endgame of the trade war remains unclear, with the potential for tariffs to be scaled back or expanded. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you again for watching. We look forward to seeing you next week.